The US dollar is flexing its muscles on the global stage. It's been on an upward trajectory, reaching impressive heights. Over the past few months, the dollar has shown remarkable strength, defying expectations and setting new benchmarks. This upward movement is not just a fleeting trend, but a significant shift that has implications for economies around the world. This surge has captured the attention of investors and economists alike. Market analysts are closely monitoring the dollar's performance, trying to predict its next move. Financial experts are debating the potential long-term impacts of a strong dollar on global trade, investment flows, and economic stability. What's fueling this remarkable climb? The reasons are multifaceted and complex. It's not just one factor, the nature of global economics. To grasp the dollar's movements, we need a reliable gauge. Understanding the fluctuations and trends of the US dollar is crucial for anyone involved in the financial markets, whether you're a trader, an investor, or an analyst. The value of the dollar can impact everything from international trade to the cost of goods and services, making it essential to have a clear picture of its performance. Enter the US Dollar Index, or DXY. This index is a powerful tool that provides a comprehensive view of the dollar's performance. It was introduced in 1973, shortly after the Bretton Woods Agreement was dissolved, and has since become a cornerstone in the world of finance. This index provides a snapshot of the dollar's value relative to a basket of major currencies. These currencies include the euro, Japanese yen, British pound, Canadian dollar, Swedish krona, and Swiss franc. By comparing the dollar to these currencies, the DXY offers a balanced view of its strength on the global stage. Think of it as a popularity contest for the greenback. When the dollar is strong, it means that it is more valuable compared to other currencies, which can have a wide range of economic implications. A strong dollar can make imports cheaper and exports more expensive, influencing trade balances and economic policies. When the DXY rises, it signals that the dollar is gaining ground against its peers. This can be due to various factors such as economic data, interest rate changes, or geopolitical events. For instance, positive economic reports from the US can boost investor confidence, leading to a stronger dollar. The DXY is the go-to benchmark for traders, analysts, and investors. It serves as a critical reference point for making investment decisions, hedging currency risks, and analyzing market trends. By keeping an eye on the DXY, market participants can better understand the broader economic landscape. It helps them assess the dollar's strength and make informed decisions. Whether it's deciding when to buy or sell assets or determining the best time to enter or exit a market, the DXY provides valuable insights that can guide these choices. By tracking its fluctuations, we can gain insights into the factors influencing the dollar's value and anticipate potential future trends. Understanding these dynamics can help in predicting market movements, managing risks, and capitalizing on opportunities. The DXY is more than just a number. It's a window into the complex world of global finance. Economic growth without fueling inflation. Economic data releases are like weather reports for the currency market. They provide valuable clues about a country's economic health, influencing the value of its currency. Strong economic indicators such as robust job growth or rising consumer spending typically boost a currency's appeal. Conversely, weak economic data can send a currency lower. In the case of the US dollar, recent data has been a mixed bag. While some indicators point to a slowdown, the overall picture remains relatively positive, supporting the dollar's strength. Section 5. Technical Analysis. Charting the dollar's course. Technical analysis is like reading tea leaves, but for currencies. Traders use past price patterns and technical indicators to forecast future price movements. By studying charts and identifying trends, they aim to predict where the dollar might be headed. Technical indicators such as moving averages and support and resistance levels provide insights into potential buying and selling pressure. While not foolproof, technical analysis can offer valuable insights for traders looking to capitalize on the dollar's movements. Section 6. A mixed bag: market sentiment and investor expectations. Market sentiment, the overall mood of investors, can significantly impact currency valuations. When investors are bullish on the U.S. economy, they tend to flock to the dollar, viewing it as a safe haven asset. This demand drives up its value. Conversely, negative sentiment can lead to a flight from the dollar, weakening its value. Currently, market sentiment towards the dollar is somewhat mixed. While concerns about global economic growth linger, the U.S. economy is still perceived as relatively strong, providing some support for the dollar. Section 7, the dollar's outlook: navigating uncertainty. Predicting the future of currency markets is a notoriously tricky business. Too many variables are at play. However, by analyzing current trends and considering potential risks and opportunities, we can make some educated guesses about the dollar's trajectory. The dollar's outlook remains uncertain in the short term. While the factors supporting its strength are still in place, a pullback or a period of consolidation cannot be ruled out. Global economic conditions, geopolitical events, and the Fed's future policy decisions will all play a role in shaping the dollar's path. Section 8. The global impact of a strong dollar. The dollar's strength has far-reaching implications for the global economy. When the U.S. dollar appreciates, it affects various sectors and economies around the world in multiple ways. A strong dollar makes U.S. exports more expensive for buyers using other currencies, potentially hurting U.S. businesses that rely on international sales. This can lead to a decrease in demand for American products abroad, impacting industries such as manufacturing, agriculture, and technology. Conversely, it makes imports cheaper for U.S. consumers. This means that American consumers can buy foreign goods at lower prices, which can increase their purchasing power and lead to higher consumption of imported products. Emerging markets in particular can be vulnerable to a strong dollar. These economies often rely on foreign investment and trade, and a stronger dollar can lead to capital outflows as investors seek safer, higher-yielding U.S. assets. Many emerging economies borrow in U.S. dollars. When the dollar strengthens, the cost of servicing these debts increases, putting additional financial strain on these countries. A stronger dollar makes it more expensive for them to repay their debts, potentially leading to financial instability. This can result in higher inflation, reduced economic growth, and even financial crises in the most vulnerable economies. The dollar's influence on the global economy is a reminder of its interconnected nature. The strength of the U.S. dollar can have ripple effects, influencing everything from commodity prices to global trade balances and investment flows. For multinational corporations, a strong dollar can impact their earnings. Companies that generate a significant portion of their revenue from overseas may see their profits shrink when converted back to dollars. Central banks around the world also keep a close eye on the dollar's movements. Changes in the dollar's value can influence their monetary policies, including interest rates and foreign exchange interventions. In summary, the strength of the U.S. dollar is a critical factor in the global economy. Its impact is felt across various sectors and regions, highlighting the interconnectedness of today's financial systems. Understanding the dynamics of the U.S. dollar and its global impact is essential for policymakers, businesses, and investors alike. It underscores the importance of global cooperation and strategic economic planning in navigating the complexities of the modern world.